This show was brought to you by MKB Bank, SAS, and EY's Forensic and Integrity Services team. Hello everyone, welcome to the Defense Line's Hungary's first podcast on the control functions in banking, insurance and corporate sectors. My name is András Bácsfalvi and I'm your host for the show that brings you real value and hands-on takeaways from the field of compliance, anti-money laundering, IT security, fraud prevention, risk management and internal audit. In order to achieve these ambitious goals, I'm gonna be joined by my colleagues who are not just the best in what they do, but they also have inspiring personalities that helps them through their journey of their professional lives. My today's guest is Sorin Anghel. Sorin is an engineer by his background and joined PW Central and Eastern Europe in the 90s, being involved in the audit and advisory activities mostly for financial institutions in the Czech Republic, Romania and the former CIS space. He has continued his career for 7 years with JP Morgan Chase as Senior Financial and Operations Officer in Romania and Belgium, being member of the board of the directors for the respective subsidiaries. In these positions, he has been approved by and been in close contact with the regulators to ensure compliance with the regulatory frameworks in which he has been active. In the recent years at SAS, he has used his analytical skills in the development of risk and compliance products. In his advisory role, he has implemented more than 150 projects in the domains of operational risk, AML compliance, fraud, and cybersecurity. He has worked with customers across EMEA, Asia, and Americas to implement risk governance frameworks, adopt the risk-based AML and customize solutions that are solving practical challenges facing the respective institutions. Hi Sorin, welcome to the Defense Lines.
Hello András, nice being with you in this interesting series of podcasts and hope that there are going to be some interesting and useful ideas developed during our call.
Thank you for accepting my invitation. The World Health Organization declared the COVID-19 outbreak an international pandemic in March 2020. Since then, the pandemic has had an unprecedented impact on people's lives around the world. Countries have responded by imposing a variety of public health measures and implementing stimulus programs to help protect individuals and companies. As we all see, changes in behavior as a result of the pandemic, whether the behavior of individuals, companies or governments, have in turn presented criminals with the new opportunities to commit crimes and launder the proceeds. What challenges has COVID-19 created and how have you overcome them?
Right, this is a very actual and relevant situation. Because indeed the COVID-19 pandemic is probably the most serious challenge that we, as well as financial institutions and companies, have faced in our lives. Just to mention some economic crises, the traditional brick-and-mortar retail banks finding themselves dealing with an unexpected situation that required them to take some concrete steps to reposition themselves, and at the same time recalibrating the operations and controls in place and so on. It can continue this way. Among the most visible aspects that have been impacted, it's really the main banking operations in general and the retail banking in particular, especially the brick and mortar, and the shift to more online banking among the customer bases with some implications on the behavior, also on some of the, let's say, less favored segments of the society, or, the older, which are less, prepared for adopting new technologies. It was quite visible, the impact on credit risk, including some of the government measures in order to give some holidays or some support. Banks have also been impacted a lot on their business continuity planning, so they have to face a situation which they were not prepared, and at a certain time, especially with a first lockdown situation, respond to the requirements of their customers and, keep the market going. And to all of this, I think that the never-ending cost trimming exercise has pushed a lot for more online technology and some more innovation in this field. Your question was specific about the money laundering environment, and I have to say that the usual threats that we were, used to have changed a lot too. And I think that the most clear tendency has been a shift of the criminal activities towards online financial services and virtual assets. So to give you some examples of situations that have favored financial crime, you may remember that for the first period at least, the public offices were closed and therefore expired ID cards have to be accepted to a certain extent or were there in terms of opening a new account or onboarding customers. The overall economic downturn has also impacted the number of businesses and therefore, in my opinion, they have become an easier target to be used at the front or as a front of the illicit activities. Some of the new things that have appeared as well is some misappropriation of the economic funding that was offered in support of the business or as a stimulus. And also the increased demand for medical supplies has created what we call nowadays medi-fraud. So actually, there was a lot of bogus companies which have entered into contracts, received money, but provide nothing or provide, substandard medical equipment and masks and so on. And basically all these activities, all the funds that were obtained using this type of financial crimes were looking for new ways to money launder these proceeds. I will also mention that we have also seen a substantial increase in cyber crimes and some ransomware, especially taking advantage of this new environment where a lot of activities were online. So we also have seen a response to the situation where some transitory measures have been put in place. I already mentioned including accepting expired ID cards within certain limits, delaying some of the KYC verification aspects, but at the same time, putting some controls in place by limiting or putting limits that would compensate for this less than sufficient KYC process. However, I want to be positive and say that we have passed the shock of the first lockdown and we have learned a lot of lessons from it. And a good number of the financial institutions that I've been in touch with have used 2020 to digitalize their operations and move a number of their IT solutions on cloud. So as a result, the operations, including the procedures, the controls in place, have been revised and adapted to the new context. So it was, if you want, a good opportunity to re-engineer the operations and to think again, not only in terms of controls, but also in terms of efficiency of these processes. And I believe that this is a proof of our adaptability, that faced with such a challenge, innovation and accelerated shift to new technologies have played an important role in accommodating this new operating environment.
As technology leads the world competition of development, FIs face a huge gap in technological tools for the fight against money laundering. The tool that can evolve anti-money laundering activities is artificial intelligence. This humankind logic interface can change the entire role and structure of an AML department. Can the usage of artificial intelligence be the holy grail in the fight against money laundering? How can we use this new tool during our work? Is this our future or is it just a dead end?
Artificial intelligence is an interesting topic, but we will need to consider it carefully. So from my experience, we are seeing the first results coming in areas such as targeted marketing campaigns or developing, monitoring and maintaining credit risk models. As it is a very broad subject, I will just mention some aspects that are already proven to work in practice. So where exactly are we at this stage? We have to remember that most part of the financial institutions are using rule-based approaches, and unfortunately, they are not always flexible enough nor revised periodically to reflect the changes in the risk factors and the new scenarios that impact the anti-money laundering framework. There are a couple of key ideas and steps to assure success with an AML function shifting to a model-based approach powered by machine learning. I remember that back in December 2018, a joint statement was issued by the US authorities, and it called for financial institutions to innovate and to approach new technologies in order to consider, evaluate, and where appropriately, responsibly implement such new innovative approaches in order to meet anti-money laundering compliance obligations. However, there is a clear message to do this in an experimental way, in a sandbox, in a testing environment, or in parallel with the current existing methods until these new approaches are proven in practice as working as expected. So the clear message there was, innovate, but with caution. And in consequence, the most part of our colleagues in financial institutions have considered using a hybrid approach. Because at this moment, nobody's really abandoned their rule-based systems and, fully replaced them with analytical models. So we're seeing a hybrid approach where rules that are used and are working are kept, but they are supplemented with models, especially where rules have certain shortcomings. And such analytical models are clear winners in situations where one needs to identify complex patterns or networks from the normal, well-defined behaviors. Therefore, in the first steps, the existing rules should be carefully considered. The current effectiveness is relatively low, and it generates a large number of false positives that are consuming a lot of energy in order to be investigated and decide whether SARs are required to be reported or not. So I would say that one of the first objectives will be to analyze the data using the expertise that the anti-money laundering team has already gained and certain statistical analysis to establish an utility function which represents the bank's preference towards false positives and true positives, alarms, or number of cases in the investigation queue. So in this case, I will follow again a risk-based approach similar to what we are using, for example, in modeling credit risk behavior, consisting in some practical steps, such as, for example, starting by identifying the features for defining the relevant clusters and customer risk profiles. I will take a more analytical approach to segmentation. And for example, one of the measures that look to be very effective in this context is a k-means clustering. This is a very popular machine learning algorithm, and it allows to group entities based on the interactions among the different variables or characteristics that an individual and those clusters or groups are sharing. That would help in the first place in designing the risk profiles, the model of the risk profile that a customer may have. It would allow us to define the utility, or you may call it a cost function, that will need to be optimized. It will allow us to train the model using all the available data. And as banks have implemented anti-money laundering measures and systems for a good number of years now, I think that having that data available and using it for training these models and also evolving that data in order to seek for these patterns is a very useful tool. Now, once you have defined the testing methodology and the test and validation data that is going to be used, I think that the best or the next step here would be to run the model in order to predict the customer risk, the customer behavior, to try and predict the false positives that may come, and now close the cases if the customer or alert risk is going to be considered low. So that, in my mind, would help in diminishing the work volume in order to let the people concentrate on what is really important. I would say that another common method of fine-tuning the AML transaction monitoring models is through applying statistical methods known as above-the-line and below-the-line testing. These are approaches that are used to validate and calibrate the thresholds and the parameters which are used eventually even the relative weights in between different rules within that set in order to optimize it. I'm more in favor of the above-the-line methodology, and therefore the thresholds are increased gradually, maybe even a bit decreased, in order to try and arrive at the best balance, at the best possible thresholds and parameters, at the level of sensitivity required in order to detect more real positives in the overall exercise. So these thresholds are therefore adjusted in the software testing environment, and the alerts that are generated, they are overlooked over a period of time, let's say the previous 6 months, and therefore from this analysis, that would allow the feedback to the model and to a potential recalibration or fine-tuning of those models. So I personally observe that this above-the-line methodology works well, but I say that testing should be performed periodically to ensure that the model is correctly calibrated and keeps with the new trends or with the new types of behaviors and transactions. And the nature of the customer, the accounts and the transaction data can evolve. And this is one of the reasons that I think these changes should be reflected in the model, the way it is structured, and how these thresholds are calibrated. There are probably some other aspects that I would like to consider. So, you know that establishing a rigorous model governance is very important. And if you're looking at the trends, the model risk governance is another hot topic coming also from the regulators. And we have seen a lot of requirements in the past couple of years. So in certain jurisdictions, it may be even compulsory to keep a repository and to maintain it and to have the risk profiles of the models themselves, i.e. understanding how they will react to different situations. Another important thing is that we need a lot of data in order to develop, train, and apply these models. And usually this is customer data. So in the first place, the data quality is critical. In the second place, I would say that there are certain implications which are coming from the European Union and GDPR regulations in terms of the data processing and including the legal requirements in respect of the legitimate scope for the processing, profiling, which is adding some additional risk to the data processing, to the personal data processing, or using encrypted data, which enables the transfer and the usage of this data without necessarily having access to the individual data. Another area where I believe that machine learning and artificial intelligence in general is very powerful is learning to detect the rare events. So here, what we call an unsupervised learning model is really the one that can churn through huge volumes of data to find some unknown pieces of risk, of evidence that would be quite difficult to determine using some of the traditional methods. So here we're looking more at detecting those edge cases behaving out of the normal relative of their peers. So to conclude, I would say that if we add to all these methods that we have discussed, evaluating cognitive computing capabilities for character recognitions, which can reduce significantly the effort of reviewing and using the information captured in the KYCs, I think that the future of AML will be converging all these, financial crimes, processes and systems together, so we can cover not only anti-money laundering, but also fraud, cybersecurities, and other risk functions into a central unified environment with integrated data orchestration, with applied analytics that would help the decision-making process, integrate the case management, the reporting, and the governance in one complete piece, and having comprehensive workflows and dashboard views to cover them.
According to the FATF guideline, virtual asset service providers must apply a risk-based approach and risk assessment like all the other financial institutions. Are the FATF recommendations on cryptocurrency regulation helpful and useful for all of us?
What do you think about the growing importance of cryptocurrencies in general? Is it a big business opportunity or is it way too risky?
Again, we are dealing here with a quite vast domain, so I will not necessarily discuss the riskiness of speculative investments in cyber currencies. But I would rather start by thinking that we should make some distinctions. First, we should distinguish in between cryptocurrencies per se, or virtual assets as they are more and more referred to nowadays, and the technology behind them. And it is clear that the technology provides for important benefits in terms of speed, of reduced cost, limited potential inflation effects for some of these cyber currencies. On the other side, the anonymity might be a double-edged sword, since the interest of the user and regulators might be in contradiction, especially in what we are discussing today, which is the anti-money laundering context. Second, we need to make a distinction between the virtual assets and the providers of virtual asset service, which is what are called the VASPs nowadays, including, the online exchanges, the initial public offerings, virtual assets-based derivative instruments, or other providers of services that allow the conversion between the fiat currencies and the cryptocurrencies. So for me, it is clear that we are looking at an increasing competition on, I would say, at least three levels. The traditional financial institutions versus the new emerging fintech companies, the traditional payments mechanism versus the emerging peer-to-peer payments, and if you want, even as a third element, a competition in between different jurisdictions in accommodating and adopting a legal framework for these new instruments. So in my opinion, FATF has or had to intervene in this maturing environment, and the real question was more when rather than the how. So FATF has produced at least two important documents in this respect, notable the 2018 recommendations, which were after that followed by the guidelines for, again, a risk-based anti-money laundering, and the document on the red flags. At the moment, a majority of the jurisdictions I have seen and worked with do not yet allow opening account or the trading in the virtual assets. So I believe that we should closely look at the FATF recommendations as well as some pioneers in this field, like Japan or Switzerland, which have recognized the facts and implemented the legal frameworks for such transactions. The main point here is that there is a clear need to create a level field environment where virtual assets are recognized as financial instruments and can compete with other financial instruments. The regulatory frameworks that has been recently implemented in the countries I mentioned before, they should not come as a surprise, since they're mainly requiring these virtual asset service providers to register and follow the same rules as other financial service providers, the traditional service providers. And if you allow me a small comment, I think that we have seen similar approaches in the past, for example, when we're discussing the taxation of radio stations or the online shops at their beginnings and so on. The FATF recommendations on cryptocurrencies regulations are helpful and useful since they are bringing clarity in the field and are giving a minimal set of requirements to be followed, as well as the risk factors that needs to be considered and monitored. However, I will again give a note of caution here, because we are still in the beginning and we'll need to follow the trends to understand better how certain risk factors would materialize and can be mitigated in order to reduce, I will not say avoid, but significantly reduce the money laundering and other financial crimes risks. I believe that the same factors that as beneficial ownership or source of funds will need increased attention and due diligence in the virtual currency world, even more than what we are used to see nowadays in the traditional financial services. So I would expect that the regulation will continue to evolve by closely following the evolution in the crypto instruments and markets, and the compliance will concentrate on both financial crimes and also taxation.
And what kind of KYC due diligence approach do you prefer? Why is KYC important in the first place?
Well, KYC has been there for as long as I remember and has substantially evolved a lot since its beginning, where we had those paper checklists. Again, I'll take here a risk-based approach in deciding how to conduct and document a KYC. At the end of the day, the Know Your Customer is a legal requirement. It is about demonstrating that a proper customer due diligence has been conducted and reviewed periodically. In this process, the business has to be verifying the identity of its clients and assessing the potential risk to the business relationship. So here we're looking mostly at the customer risk, but also consideration should be given to the economic segment and geography into which it operates, the services used, and the channels of communication, the distribution channels that are employed by the respective customer. So this customer due diligence should be performed before entering into a business relationship by obtaining all the required information about the identity and location of the potential customer and gaining a good understanding of their business activities and financial stability. This can be as simple as locating documentation that verifies the names and the address of the customer and trying to understand who might be, at the end of the day, the beneficial ownership. So, in the first place, you'll have to decide whether a customer or client fits your established risk profile before entering into a business relationship with them, and this can only be done by undertaking the appropriate CDD measures. I have to say that, however, in a number of cases, especially when entering a new market or launching a new product, the CDD process is so light that may not easily pass the requirements. In some other cases, I have seen financial institutions that have a clear policy on when and how to decline or interrupt a business relation, but this is not a general rule. So sometimes I feel that they are not really prepared to say no in certain cases. So this process should be strengthened wherever possible by relying or obtaining information from third parties. And in recent years, I have seen a number of public and private databases that have appeared not only for the traditional legal entities, but also for individuals. And here I have in mind mostly the high-profile or politically exposed persons in certain regions or geographies. Now, beyond basic customer due diligence, I think that it is also important to determine in the cases where we're seeing a lot of high transaction value accounts that deal with high-risk countries or accounts that deal with high-risk activities, I think that this should trigger a mechanism where a deeper exercise should be conducted. So factors to consider to determine whether an EDD is required should include the location of the persons, the occupation of the persons, the type of transactions, and at the same time, we need to develop an expectation of the pattern of activity in terms of what types of transactions, what values, what frequencies have to be expected for that particular customer or that particular group of customers. Also, I would look a little bit on the expected method of payments. So again, if we see a very different type or a different behavior, that should also be a good signal that we have to extend this customer due diligence exercise. I would say that here I would apply a general rule, which is a common sense rule at the end of the day. So when authenticating or verifying a potential customer, I would classify them into different risk categories and define what type of customer they are, what is their expected behavior, transaction pattern. So how can I really mitigate any potential risk that we may encounter in dealing with that? So at the end of the day, it is about understanding the risk factors and applying that common sense that I was mentioning for the customer onboarding and maintaining of this or of a business relationship. Just a quick reminder here, because actually it is a good reminder from the COVID situation. So in certain cases, we have seen problems, and I would recommend that we have to store the records of instances of CDDs and EDDs and any additional documentation securely in a digital format so it can be easily accessed and presented in the case of an audit.
And how should a bank or any company measure its risk appetite? What factors play into this? Is AML compliance purely about avoiding risk?
Right, so allow me to go back to what I strongly advocate before, and this is really an enterprise risk-wide risk framework. So most part of the banks and companies I work with have made important steps into this direction and have fully integrated the identifiable risk an organization is prepared to take and which are inherent in their business model. So for example, in banks, most of these are clearly defined: credit, interest rate, liquidity, operational, compliance, conduct, strategic or reputational risks. The starting point is by developing a risk appetite statement. And a risk appetite statement is a narrative that describes a bank level of risk tolerance in this case. How much risk are the board and the top management willing to take and incorporate into their balance sheet? So such risk appetite is directly related with the capital and reserves, some of which are regulatory requirements, the positions of the institution. So here I'm seeing a combination of monetary items as well as procedural narratives. The second step would be to determine at the level of each business line what are the risks to which they are mostly exposed to and allocate such overall risk appetite among them. Unfortunately, in some cases, I still see some financial accounting exercise to allocate or using an indicator based on the assets or probability of that unit. But more and more, I'm seeing a bottom-up approach where using historical losses and fines, using scenario analysis as well as K-risk indicators, the models are used to determine the economic capital and eventually stress test it before determining the risk tolerance capacity of the institution. So the main purpose of the risk appetite is also to align an alignment of the risk profile and hence allowing the identification and assessment of K-risk and controls to be implemented in order to keep within pre-established limits. I would say that even more important than measuring the risk appetite is using it as a compass to monitor the risk heat map, including new and emerging risks. So my approach here will be using a similar system to the red, amber, green that we are using for K-risk indicators, which should be closely aligned to this risk appetite. This should also satisfy the need for information required by regulators and shareholders and ensure transparency and good corporate governance. I have to say that while in the beginning the compliance functions were a bit slow in adopting risk-based methodologies, including concepts such as risk likelihood or risk appetite, in recent years they have integrated well and are bringing an important contribution into keeping up to date a working risk governance framework.
We are approaching to the end of this interview, so I only have one question left. As we all experience, AML compliance seems to be more and more important all around the world. How do you see the future of this profession?
I agree with you in respect of compliance in general and financial crimes in particular, getting more attention and an increased level of requirements and complexity. Just as an example, you have seen the provision of the 6th anti-money laundering directive issued by the European Union that came into effect and which must be implemented in June of this year. So the scope has been extended from, the traditional money laundering and terrorist financing to now cover a harmonized list of not less than 22 predicate offenses that constitutes money laundering, including certain tax crimes, environmental crime, and cybercrime. The inclusion of cybercrime is significant in my opinion, since it is the first time it has been featured in this context in an European Union money laundering directive. This means that financial institutions within the member states will have to ensure that their current AML programs can deal with a new risk environment scope that is included. This means that firms may need to train or retrain employees or change slightly the character or the skills of the team in order to adjust their AML programs to ensure that they can detect suspicious activities that are now more complex and on a larger scope. The second point is that now what is called aiding and abetting will also constitute money laundering and be subject to the same criminal penalties. So now money laundering regulations will not apply only to those who profited directly from the act of money laundering, but also the so-called enablers will also be legally responsible. Now, coming back to the basics, I think that we need to do our homework to anticipate and prepare for these compliance evolutions. The starting point is having a solid governance in place that includes up-to-date harmonized processes and policies. In the past, I saw a lot as an immediate response that people were hired to cover the increasing volume of work. But in the current environment, this is no longer tenable, and the compliance function must do more with a limited number of resources. So there is a need to rethink the role of compliance and ways to deliver compliance assurance services in a coordinated way with other assurance services, departments like audit, internal controllers, risk management, and so on. And I would say make an investment in compliance by taking a step forward and creating the right mix of people, skills, processes, and technologies. A suggestive comparison that I have seen describes the way most compliance functions currently and operating as a pyramid. There is a broad base of transactions processing taking up most of the picture. Reporting and compliance is a narrow segment in the middle, and insight and action is really at the nice-to-have function at the top of this pyramid. Ideally, this pyramid should be reversed and intelligently applying technologies, some of which you have discussed before, like artificial intelligence, machine learning, deep analysis, and deep learning, would really allow us to apply them to the team processes. So the people that are working and can bring value to this compliance function can spend more time in getting some insight, in understanding better the processes and the risk factors and initiated action that would change the business in respect of its effectiveness. So automating where it is making sense, not everywhere, will allow organizations to free up experts to work on things that really add genuine value to the business. I suppose this was the reason why you have asked about using AI and machine learning in the first place in one of your previous questions. Another important aspect is, for example, to create a corporate culture that ensures awareness and helps prevent non-compliant behavior. It also means making the transformation from what nowadays is a pure investigator into a trusted business advisor for the operations of the financial institution or of the... So becoming a function that is seen as a facilitator of responsible, creative, aware risk-taking rather than really an obstacle to other departments.
That's a very good point.
Exactly. Sometimes we were seen as a barrier to realizing the profits and to conducting or opening new business opportunities, new product launch, and so on. So automating is really about making sense in areas where there is such a large volume of data and of transactions to be processed, and freeing those resources and repositioning them in a way that it is more useful. So I see a lot of trends here in transforming the compliance model by using, for example, managed services, cloud embedded technologies, which can be plugged into the bank core operation chain. And there are a number of advantages that I see here. So banks should standardize as much as possible and apply standard processes, and only on top of that adopt to their specific needs, requirements, whether they are business requirements or legal requirements, which are applicable to a certain marketplace. And that would also assist in the sense that there is a reduced IT cost overall, because the companies will not have to build every time a high-end technology platform by themselves, but rather, I would say, cooperate, because this common intelligence is going to be embedded into these solutions. And also my recommendation would be to increase a little bit the cooperation in between the financial institutions in the exchange of information and the exchanges of ideas on how to make this compliance function more effective and more adapted to this quick changing environment.
Sorin, thank you very much.
Andras, you're welcome. I hope that there were some good ideas during our discussion, and I wish you success with this podcast series, which is probably very useful to the practitioners in the compliance, risk and governance context.
Thanks for joining me today. You have just listened to the Defense Lines, the podcast for the control functions. If you found value in this episode, please subscribe so you will never miss a show. András Bácsfa is signing off, but till our next meeting, do not forget, those who try to convince you that safety can be increased only by jeopardizing your business goals will eventually deprive you of both.